In this session, I would like to introduce you to the world of derivatives. We all know that derivatives is one of the newly entered financial instrument which entered into the financial markets probably in the last 40 years after 1970 itself. But today we see that there is a lot of craze that goes behind the derivatives market. There's a lot of volume that goes into the derivatives market. Number of participants who are playing in the derivatives market is extremely high, and today it is becoming one of the most important branches in the world of trading. Almost every financial institution gets into the derivatives trading. Every bank is playing in the derivatives market. So almost every financial institution, or at the same time there are so many new financial instruments that are getting created using the concept of derivatives. So that's one of the prime reasons every one of us need to have a comfortable understanding to the world of derivatives, right? And as we have been observing over the past couple of decades, that the derivative trading happens in two ways. One is over the exchanges, where wide varieties of products, especially products like futures and options, they are traded widely across various exchanges over the world, and at the same time some kind of derivatives are traded over the counter. Over the counter is more like between the two parties. So here we see some kind of derivative products like forwards, swaps, and even some kind of options are also traded in the over the counter market. And today there is a huge trading across almost all the exchanges for futures and options. There are lots and lots of high volume, high valued contracts that are happening in the over the counter market with respect to forward swaps and different other kinds of options. And everyone, financial institutions, or probably the fund managers, and every other participant is looking forward for some kind of investment or the other with respect to the derivatives opportunity, derivatives market. And on the other side, derivatives are getting packaged. We have observed that today derivatives are getting packaged into various other products, like they are packaged with bonds and called as bonds with embedded options. Typically we hear the words like callable bond, convertible bond. It's as good as a derivative being packaged with respect to those bonds. Or probably we look at with respect to the compensations of the employees, a derivative instruments being packaged into the compensation, employee stock options, ESOPs. Or sometimes we are seeing that the derivatives are packaged along with the investment decisions, wherein the world of real options have come up. So what we are seeing here is the concept of derivative is getting packaged with various other financial instruments also, which means the more we understand the world of derivatives, the more we can try to understand even the products which have packaged them, and probably take our decisions quite effectively in the financial space. So with that as the base, I just want to give a brief introduction of the derivative. We all know a basic definition. Its value is derived. from some underlying asset. So which means it is not it's not something in isolation. The value of this particular derivative instrument is derived from the value of some underlying asset. Probably if I say derivative on Infosys stock. So whatever is the derivative product which I am creating, the value of this derivative, the value of this derivative will change in line with the stock price of Infosys. So this is not something in isolation. So its price is always based on the underlying asset. This underlying asset today can be almost anything. It can be stock, it can be bond, it can be a stock index, it can be a currency, it could be an interest rate, it could be almost anything. And today, not just, or it could be a commodity. So, based on the price of these things, the value of the derivative is getting derived. But not just limited to this. Probably I can create a derivative instrument, let's say based on the weather. If the temperature on a particular day is more than something or less than something, I'm going to pay you something. If it is the other way, you have to pay me something. So the derivatives are something like that, right? Wherein the payment, wherein the agreements are coming up in terms of paying or receiving some amount based on the futuristic movements of the price or the value of any other underlying products or assets. So that's how the derivative market started growing up. Today, apart from these regular instruments, we are seeing heavy kind of a trading happening in the world of credit derivatives. We are seeing heavy kind of a trading that is happening with respect to weather derivatives, wherein weather is the underlying. So it's as good as the example which I have specified. If it is going to rain tomorrow, then probably I'm going to pay you some X. If it is not going to rain, then you have to pay me some Y. Such kind of agreements can come out. So there are weather related, there are electricity related derivatives that are getting traded, and probably there are more traditional ones in terms of equity derivatives, the foreign exchange derivatives, the interest rate related derivatives. We find so many such kind of active markets associated with various derivative instruments. So, so there is a huge opportunity to make extraordinary careers in the world of derivatives, provided the understanding of the derivatives market, the valuation of the various derivative securities gets completely clear for us. And so in this context, getting started with the two types of markets as I have specified earlier, there is an exchange traded market and there is an over the counter market. So when I am talking about an exchange traded, it is more like any other stock market. There is a physical exchange that is existing, and this exchange will set the rules of the trades. Exchange will set the rules of the trade, because here the rule is as simple as, okay, you are going to buy or sell something, not today but at some future date. See, most of the derivative contracts are like agreements, right? Most of the derivative contracts are agreements to buy or sell some asset at a future date. not today, at a future date, for a price that is agreed today. So what we are saying is what to buy, what to sell, when to buy, when to sell. Those kind of rules are what to buy, what to sell, when to buy, when to sell, how much quantity to buy, how much quantity to sell. These kind of rules relating to the trade are set by the exchange. That's the reason we say the exchange based contracts are all standardized contracts, because all quality, quantity, the date, all of them are specified by the exchange itself. So though the concept has been there for quite some time, the active trading has been done in these kind of markets only in the last 40 to 50 years. And the standardization can happen in terms of any of the assets. Again, as I discussed earlier, it could be equity, it could be a currency, or it could be interest rates, or many other kind of underlying assets. And generally in the exchange, earlier there used to be what is called as open outcry process, which means people generally meet up on the floor of the exchange, they shout or use some kind of gestures to indicate the trades that they want to execute. So this is like a physical vegetable market where you shout out the price of the vegetable, and someone who is interested in it, he goes there and tries to purchase it. So here also we are talking of a similar kind of a concept where people physically meet on the floor of the exchange. They try to use various signals and mechanisms to indicate their interest in terms of buying or selling something, and they get their trades executed. But slowly this open outcry process in the exchanges is giving way to electronic trading, wherein we are talking about the traders actually not meeting physically, but they are meeting virtually on the computer. They enter their desired trades on the computer, and computer will take care of matching the buy and the sell orders. So today there is a lot of move towards the electronic trading, but of course open outcry process is still existing in some parts in some of the exchanges. Whereas when I come to the other side, which is the over the counter market, probably much bigger or larger than the exchange. The reason being, here there is a lot of customization. The rules are, there is no exchange, so there are no rules, or probably no standardization, and there could be a lot of negotiation between the two parties, because this is purely an agreement between the two parties, no central place. This is more like a central place, whereas here there is no central place. It's just two parties meeting up, agreeing to buy or sell something at a future date, and agreeing on the price and quality and all the other details over the phone, itself, or some kind of a network, computer based networks, phone line. So the trades are typically happening over the counter without any physical existence or without any physical exchange being present. So generally you find that the major players in the OTC market are probably two financial institutions, or it could be one financial institution with its client. So these could be the major transactions that can happen in the over-the-counter market. Whereas when we look at the exchange-traded market, you could see even small retail investors getting into that kind of a market. And in most of the cases, we see that the financial institutions, in this case, act as market makers, When I say market maker, each financial institution will quote a buy price at which it is willing to buy that particular asset in future, and it also quotes a sell price, typically called as bid and ask, at what price it is willing to sell that particular financial asset in future. And one more important aspect here is all these OTC transactions, whatever are there, the which are happening over the phone, the discussions which are happening over the phone, they are recorded. So it can be used for any kind of discrepancy resolution kind of situation, and any party violating any of the rule of the contract can very well be addressed because of this recording that is happening. So while we see on one side major advantages coming up in terms of I should be able to negotiate a better deal, I can customize the contract, and I don't have the headache of the exchange intervening and charging a commission. But on the other side, the biggest disadvantage comes with respect to the credit risk existing. There is a very high possibility, or there is a decent probability that one of the parties may not adhere to the contract. One of the parties may dishonor the contract. So if that is the case, the other party is going to lose very heavily, and that is what we are calling as the credit risk, which could be very much present in the over the counter market. Whereas the exchange has some kind of mechanisms to virtually eliminate the credit risk, it does exist to some form in the over the counter markets, right? So we will see how the exchange eliminates this credit risk in the later sessions. But just giving you a quick differences in terms of understanding of the exchange market versus the over the counter market. All right. Now let's move on to understand the various financial instruments which are based out of derivatives. As we have discussed earlier also, there are four major kinds of derivative securities. One being the forwards, which are traded exclusively in the OTC market. Then we have futures, which are traded exclusively on exchanges. Then there are options, which are traded both in the over the counter market as well as exchanges, and we have swaps, which are traded again in the over the counter market itself. So these are the four financial instruments which are based out of derivatives. So that's where if I want to get started, let's say with a forward contract, it is a simple plain vanilla agreement to buy or sell something in future, some particular asset. It could be a commodity, it could be a currency, it could be an equity security, whatever it is, an agreement to buy or sell something in future, where but the price of it is decided today itself, at a price which is decided today. That is what we call as a forward market. Whereas the exact opposite to it, where the buying and selling is happening today itself rather than at a future date, we call it as the spot market. If the buying and selling happen today itself, we call it as the spot market. If the buying and selling happen at some future date, we call it as the forward market. But the price of it is agreed upon today itself. So as I have already highlighted that it is an OTC market, generally we find two major financial institutions, or a financial institution and its client are typically involved in these forward contracts. And in the derivatives world, any kind of buying related situation is called as a long position, and a selling situation is actually called as a short position. So terminology wise, it's worth to understand these two terms. And majorly there is a heavy market in the forwards for foreign exchange, right, where one party agrees to buy some X number of dollars in exchange for some Y number of pounds, or rupee versus dollar, or any other currencies, buying one currency with respect to the other, not today but at some future date, but agreeing upon the exchange rate today itself. Generally, this kind of transactions help in terms of fixing up the price or the exchange rate. Fixing the price or the exchange rate, which means they are used for reducing the risk regarding the future uncertainties of the price. They reduce the risk with respect to the future uncertainty in the price, and that kind of a mechanism which can reduce the future uncertainty and fix the price, the process is actually called as the hedging process. Hedging is primarily meant towards reduction of the risk or reducing the volatility in terms of the movement of the prices or exchange rates or whatever it is. So the forwards can really be a helpful contracts wherein I can really reduce the risk. For example, I have to pay someone $1,000. I have to pay someone $1,000 after 3 months, and I am in India. I use Indian rupee. Now, what could happen is, let's say currently the exchange rate between Indian rupee and foreign and US dollar is $1 equal to, let's say, 60 rupees. Now, if I have to pay $1,000 as per the current price, I have to pay 60,000 rupees. Fair enough. But I have to pay after 3 months. So, if I have to pay after 3 months, let's say after 3 months, the exchange rate has gone to $1 equal to 62 rupees. Then I end up paying 62,000 rather than 60,000. It becomes a pretty expensive exercise for me. It could have become even 58,000 also. Let's say if after 3 months the dollar has become, let's say, 58 rupees, then I could have paid only 58,000. So there is a positive side as well as a negative side. But when I am entering into the forward contract, here I will enter into the contract in such a way that I freeze. So I freeze it, let's say, at $1 equal to 60.5 rupees. That's it. Which means after 3 months, irrespective, this is where I enter into the forward contract, saying that I will pay 60.5 rupees for every dollar after 3 months. Now, the actual exchange rate could be 62 or 58, whatever it is. I know that I have to pay 60.5, which means I am freezing on the exchange rate and trying to enter into the transaction. Means I am reducing my risk with respect to the uncertainty of the exchange rate in future, so that I can plan things accordingly. So that is what happens in forward contract, because we fix the price or we fix the exchange rate upfront for some kind of a transaction that is supposed to happen at a future date. So in this particular process, let's say I have frozen the exchange rate at 60.5. Then what is that we are saying? If really in the market the exchange rate had gone to 62 rupees a dollar, then probably as a payer I'm getting more and more benefit, because here I'm having a long position on dollar. It's as good as I am purchasing $1 for 60.5 rupees. So if the market price has gone to 62, then it means that the long position who is purchasing dollar for rupees, he is getting a profit of 1.5 rupees. So the buy position or the long position is gaining if the exchange rate has actually gone up. And on the other side, if the exchange rate has gone to, let's say, 58, then probably the long position, he is still paying at the rate of 60.5 to purchase a dollar, whereas it is available only at 58 in the market. So there is a loss. So the negative position of 2.5 rupees per every dollar in this kind of a situation. So this is where this is what we call as payoff. Whatever is the possible gain or loss if the underlying asset on that maturity date moves to a particular value. So wherever the underlying asset or underlying exchange rate crosses above the fixed price or fixed rate, then the long position will be gaining. Otherwise, it's the short position that would be gaining. So typically, if I have to talk about the payoff with respect to forward contract, it's as good as saying on the maturity date, whatever is the spot price or spot rate, I subtract the agreed upon price, which is the forward price or the forward rate. I subtract from it whatever is the difference, that is the gain to the long position. Because as I discussed earlier, if 60.5 is the agreed upon exchange rate, if the market rate goes to 62, the 1.5 is going to be the gain that is coming up in this process. That is a gain to the long position. Whereas from the short positions perspective, I look at it the reverse. Whatever is the gain to the long is the loss to the short and vice versa. So the negative of the value to the long position will become the value to the short position. That is the reason, if at all I want to display the payoffs of the forward in a graphical form, I can look at it something like this. This is for the long. This is the agreed upon price, which is the forward price, or sometimes people call it as the delivery price, exercise price, lot of words. The forward price. So what we are typically seeing is, if the spot price on the maturity date, if I assume that this is the spot price on the maturity date, any spot price above this delivery price will give a profit to the long, and anything that is below the strike, below the delivery price, is going to give a loss to the long position. And whatever is the gain to the long is the loss to the short. So probably I'll take it exactly as the mirror reflection. Exactly as a mirror reflection over this x-axis. So this is what will be the short positions payoff, and this is what is the long positions payoff. So this is what we can look at a base introduction into the world of the forward market. Now the forward, because it is being mostly an OTC market, there is a credit risk that is involved in it. There is a possibility that one of the parties to the contract can quite comfortably default and break the contract. And that is where the second financial instrument has come out, which is exactly the same in terms of the definition. The futures is more or less similar to that of forwards itself. Buy or sell an asset at a future date for a price that is decided today itself. But the only difference is this entire transaction does not happen over the counter between the two parties. It happens over the exchange. The major difference between the forward and the futures is forward is mostly an OTC contract, whereas futures is an exchange traded contract. That's the major difference. So all the features of this exchange traded. So the exchange will standardize what kind of assets can be traded here, what is the quality, how much quantity, where is the delivery location. All these things are standardized, nothing can be customized here. And but at the same time, exchange takes the responsibility to guarantee all the traders the payment. So the credit risk is literally not existing in terms of the futures contract. So it makes sure, it takes that additional responsibility to make sure that none of the parties is dishonored, none of the parties default. It takes some kind of protection mechanisms. We'll talk about them slightly later in other sessions. It uses concepts of margin. It uses the concept of mark to market to make sure that the credit risk or the defaulting probabilities are literally not existing. And what we see is the futures are very heavily traded in almost all the exchanges across the world. We see that there is a heavy trading that is happening in terms of commodities, in terms of financial assets like stocks, the indices. There are a lot of futures markets running on all of them. We see them that they are running with respect to currencies. So exchange has taken up, different exchanges across the world have taken up these kind of financial instruments. They have created the derivatives on the top of them, and they are getting traded very actively in the various exchanges in the across the world. And and here the price is decided. What is the price to buy or sell? The price whatever is fixed today in the forward contract, it is fixed by both the parties, but here the price is fixed based on the overall demand and supply. So the exchange will make sure that the particular asset it is allowing for trading, the particular asset that it has selected for trading, it is having enough volume, it is having enough volume to be traded so that there are enough number of buyers and sellers. So there is a decent amount of liquidity associated with those securities, means more of buyers and sellers, the transactions happening quite frequently. So the demand and supply for them dynamically changes the price. So if the price if the demand is too high compared to the supply, the price is going to go up. Otherwise, the reverse, the price is going to fall. So this is the way the futures contracts are slightly different from the forwards, majorly because of the presence of exchange and because of the elimination of the credit risk to a large extent by the exchange because of the various procedures that it follows. Then the next important instrument that is worth looking at in this context is the options. This is one single security which is traded both over the counter as well as exchange. Means there are different kinds of options that are created. Some of the options, some of the types of options typically called as American options or European options. These are the two major kinds of options which are traded on the various exchanges across the world. But there are many other types of options which are called as exotic options, which go into various categories. These exotic options to a large extent they are traded over the counter itself. And Options are the most interesting financial instrument because they got clubbed, they got packaged very well with the other financial instruments. They got packaged with bonds, as I have said earlier at the beginning of this session. They got packaged with employee compensations. They got packaged with investment decisions. So, options are those kind of financial instruments which need to be understood in entirety because they can create many other products with the kind of characteristics that they typically possess. Now, options wise, the definition goes like again buy or sell asset at a future date for a price that is agreed upon today. Again, the logic remains one and the same, but an additional feature here is the buying and selling at a future date is mandatory for one party, optional for the other party. The same buying and selling till now, whether it is forwards or futures, the buying and selling of the asset at a future date is mandatory or obligation for both the parties. At that future date, one party has to buy, the other party has to sell. There is no other go. But in case of options, it is mandatory only for one party and it is optional for the other party. So here, out of these two parties, the buyer and the seller of the asset, anyone can take the option. So buyer of the asset or seller of the asset, any one of these two parties can take the option. If the buyer of the asset takes the option, we call those kind of options as call options. So if he wants, he can buy, otherwise he need not buy. But if he wants to buy, because the other party is mandatory, the other party has to sell for sure. If the seller of the asset has taken the option, we call it as put option. So what we are trying to say here is it's an option for one of the parties to buy, or probably if I use the word call option is a contract where the buyer of the asset has the option to buy the asset at a future date, whereas the seller of the asset is mandated to sell that asset if the buyer wishes to buy it. Similarly, when I bring the concept of put option here, it's an option that is available to the seller of the asset to sell the asset at a future date for the agreed upon price. And if he wishes to sell it, there is no other alternative for the buyer. He has to buy that particular asset. So that is the concept that is behind the options. Of course, there's a lot of mathematics that is involved in these options. There are a lot of calculations involved, which we will look at them as a part of our future session. But in this options, again, the future date, if the future date of exercising or expiring is the last date, which is the maturity date, if the buying and selling can happen only on that expiry date or on the maturity date, we call those kind of options as European options. Whereas if the exercise of that option can happen any time up to the maturity date. So if the maturity date is 1 month from now, if the buying or selling actually happens only on that 30th day, we treat those options as European options. But if the exercising of the option, the buying and selling of the asset can happen any time in the next 1 month, then we are calling those kind of options as American options. They can be exercised at any time up to the expiration date. So here one party is having the option either to go ahead with the contract or back out of the contract, whereas for the other party it is mandatory, and that is one of the prime reason. The party which is willing to take the option, the party which is willing to take the option, in case of call option, the buyer of the asset, in case of put option, the seller of the asset, whichever party wants to take the option, they have to pay they have to pay an initial premium amount. They have to pay an initial premium amount to the other party. So the party which is taking the option has to pay an outright premium to the party which is not taking the option, or which for which it is mandatory or obligation to adhere to the contract. So while in case of forwards and futures, there is no initial movement of money from one party to the other. There could be a security deposit kind of stuff which we'll discuss about later, which is called as margin. But there is no outright movement of money from one party to another on day zero, on the day of entering into the contract. Whereas in case of option, there is an outright movement of the premium from the option taker to the option giver. So that is one major difference that is coming out. On day zero. There is a direct cash outflow that is involved. So there is a cost to the party on day zero. Whereas when we are looking at forwards and futures, no such kind of costs, no such kind of cash outflow exists on day zero, on the day of entering into a contract, right? So there are lots and lots of American and European options on various stocks, commodities, and currencies that are traded in various exchanges across the world. And similarly, there are various other kinds of options. There are something like Asian options. There is something called barrier options. There are something called Bermudan options. There are so many such kind of exotic options which are not traded on the regular exchanges. In fact, they are traded on the over-the-counter markets itself. We'll discuss more and more of these options and their valuations, their pricing mechanism, various things at a later date. But typically, just if I have to summarize the major players that are there in the options market, I talk about four of them: buyer of a call option, buyer of a put option, seller of a call option, and seller of a put option. What are the roles for this? For this person, he is having an option to buy an asset at a future date for a price agreed. So he is having an option. If he wants to buy, he will buy it. Otherwise, he will not buy it. Whereas for a buyer of a put option, he is having an option to sell. If he wants to sell it at a future date, he can sell it. Otherwise, he need not sell it. Whereas for a seller of a call, his position is completely dependent on the buyer. If the buyer wants to buy, this person has to sell the asset. So for him, it is mandatory to sell the asset in case the buyer wants to buy. Similarly, for a seller of the put, it is mandatory or obligation to buy the asset in case the buyer of the put wants to sell it. So we see that these are the different kinds of positions that could exist in the options market, and using these four positions people create different kinds of option trading strategies. We'll look at these strategies at a later point in one of our futuristic sessions. We talk about wide varieties of strategies that can be engaged with respect to the combination of these options. And as we have discussed earlier, also with respect to forwards, any buying position is called as a long position, any seller position is called as short position. Or, and the other word for buying of the options, we also say that we are talking about the owner of the option or the holder of the option. Whereas in case of selling positions, we say the writer of the option, or we talk about the seller of the option or the writer of the option. All these things mean more or less one and the same. Now, the next important concept that I would like to bring out is the swap. Again, swap is also a kind of a contract, which is the over the counter kind of a derivative contract itself, which is again an agreement between the two parties to exchange a set of cash flows at predetermined multiple intervals. So every quarter, every month, something like that, predefined intervals based on some notional amount. So here probably it could be like, okay, there could be something called interest rate swap. Interest rate swap, A and B have entered in, let's say for a 2-year period where quarterly payments are done. Means the cash flows are exchanged 8 times, because it's a 2-year swap where the cash flows are exchanged on every quarterly basis. We are talking of 8 different cash flows. Probably here it could be like on some $1 million, A would pay A would be paying a fixed 8% per year interest rate, whereas B could be paying a floating rate based on some reference. Now, this is what are the payments that are happening at regular intervals for the complete 2-year period. So, it's not one single transaction, it's a set of transactions, and even in that set of transactions, we are talking of periodic exchange of the cash flows based on the different norms. Both the parties are paying cash itself, whereas in case of forwards and futures, we might very well see that one side of the transaction could be an asset, whereas the other side could be a cash. Whereas here it is clearly that both the parties are exchanging the cash flows based on some notional concept, and whichever is the agreed upon criteria, it has to be planned out for the entire swap period, and the payments are happening at regular intervals of time. More and more details in terms of the valuation of the swap, the mechanics of the swap, we will deal with it in the future succeeding chapters. So here just an understanding of these 4 different kinds of derivative contract is necessary for us. Now once we have a decent understanding of the different kinds of derivatives contracts, the other dimension that we need to understand is who are the different types of traders in the derivatives market. We see that there are 3 major kinds of traders in the derivatives market. One is a group called hedgers, whose objective is to reduce the risk, whose prime objective lies in terms of reducing the risk. Whereas on the other side, we find a group called speculators whose major objective is take the risk, take the risk and benefit from the positions and benefit or make profits out of the positions. So this is a speculator's role. Whereas on the other side we see another group of traders called arbitragers whose major role is take different positions in different markets and lock up profits. They want to lock up profits, and at the same time they 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 make their trade in they understand the price asymmetries or price differences that are existing in the various markets, price anomalies that are existing in the various markets, and they try to take the advantage of those price anomalies. Buy in one market, sell in the other market, the same asset, and try to lock up the profit, or probably a futuristic buy at one price, futuristic sell at the other price, both of them being assured the prices of buying and selling, which results in a net profit to be made because both the future buy price, future sell price both are known. So they try to find opportunities which can create those kind of pricing mismatches in various markets, and they try to execute their positions. In general, we see this derivative market is today highly liquid. There are enough number of participants, different kinds of traders who play one of these roles, and they try to finish up they try to execute the trades quite quickly, so that the trade is happening smooth, the prices are updated at regular intervals. So these three roles are acting together to bring a lot of efficiency and perfection into the derivatives market. So from a hedging perspective, let's say, just to take a quick example, let's say a company wants to use a raw material X into its production process. Now, it wants this X not now, but probably 3 months from now, 6 months from now, so that it can use it into the production process. But it is somehow worried that the price of this X, the raw material, can go up in future. And if it generally goes up in future, and if the company has to procure that raw material at a future date, its cost of materials is going up, which means its profitability can come down. Now this is where the company can think of entering into a derivatives position, derivatives long position for this X, with either with the exchange or with some other counterparty, saying I will be buying X, this much quantity of X 3 months later for this much price. Now if there is a seller party who is willing to get into the transaction, the deal is done, right? But from the buyer party's perspective, it has reduced the risk because it is able to freeze the price of the raw material, so it can plan the sales and the unit price of the finished product quite comfortably because it knows what is the cost of the raw material. So wherever we are talking about an underlying business usage, and based on that underlying business usage, if the company is entering into a derivatives position to reduce the uncertainty of the price or rate or any such kind of things which can produce the loss for the company in future, in that kind of a role, we are saying that the company or the trader is getting into a derivatives hedging position. He is using the derivatives for hedging purpose. Here, the prime intention in case of hedging is only reduce the risk. A reduced risk can always result in reduced returns also. So it cannot be said with any kind of a guarantee that the company's position is always better off by taking the hedging position. It's only the risk gets reduced, the uncertainty gets reduced, but it cannot be said always that the profitability of the company will improve, because it is sacrificing on the returns also as a part of reducing the risk. So any of the instruments, probably forwards, futures, swaps, or even options, any of the instruments can very well be used from the hedging dimension perspective. The only difference between, let's say, the forwards and the options, the forwards are more in terms of fixing up the price. So if in the future the spot price goes much below the forward price, the the long position is experiencing a loss also, whereas if the spot price goes much above the forward price, the long position is even getting into a gain. So it is primarily a fixing of the price in case of usage of forwards. But if I am using options, it's more like an insurance. I am paying a fixed premium to the other party so that my losses are being reduced, but I have the potential to gain, because when as long as things are favorable, I'll keep exercising the option and I'll try to get the gain out of it. But only when things are going unfavorable, the prices are going unfavorable, I will not exercise the option, which means I will lose only my premium and nothing more than. So that is where we say the options act more like insurance. They try to protect from the adverse price movements, but at the same time they give the facility that you can benefit from the favorable price movements. But of course there is an initial payment that is involved with respect to the option contracts, wherein a premium is being paid from the buyer of the option to the seller of the option. Whereas when I look at the derivatives, probably a hedger who wants to reduce his risk, he will enter into a contract with a speculator who wants to take the risk for the same. So either it is in case of options, the speculator's role is he will take the premium from the buyer. He may try to get a benefit out of the risk that he is taking. See, or he may not have any kind of a production process in place, but he just wants to bet on the prices of X. He assumes that the price of X is going to go up in future, so he wants to lock up the price today with an intention so that he can sell that X at a later date at a higher price, and he wants to make a profit out of it. Here the difference is there is no business intention or a business risk that is involved. He is the only motive for the speculator to play in the market is a betting on the price. He feels that the price may either go up or go down in future, and he wants to take an advantage by getting into a position accordingly, and probably benefit the hedger who wants to reduce his risk. So he is ready to willing to accept the risk which the hedger wants to reduce, and because of that there could be a trade that can exist both between the buyer and the seller. The hedger and the speculator can come together for an execution of a trade. So that is what we can look at with respect to the speculating positions using any kind of securities, forwards, futures, options. Right, more or less the behavior remains the same. The party who is getting into a speculating position, the intention is to bet on the price movements or the rate movements and try to take an advantage of the overall position. Whereas, as I said, with respect to the third role, the arbitrageurs, they are majorly interested in locking up profit. The arbitrage itself talks about riskless profit. Means the profit is assured. I get into a buy position, I get into a sell position in two different markets. The cheaper market, I get into a buy position for the asset. The expensive market, I get into a sell position for the same future date. So on this future date, the buy price is known, the sell price is known today itself, which means the overall benefit that is assured at a future date is known in advance itself. That is what is the role of arbitrager. But yeah, finding up that kind of suitable arbitrage opportunities in two different markets requires heavy tracking, and probably this arbitrage opportunity may not be available for long. It could be for a very short term, because once someone identifies that this kind of an opportunity is existing, there is a heavy demand for executing that particular trade. So more and more demand for one versus the other increases the price of the cheaper one, decreases the price of the expensive one, and overall these two prices can come out at the equilibrium layer itself. So, the arbitrage's major role lies in terms of identifying the opportunities as quickly as possible, executing the trades as quickly as possible, and try to lock up the profits. Even these kind of roles are very heavily present in the derivatives market. And though on one side we see that the derivatives has been growing, the instruments have been more and more innovative, lots and lots of mathematical calculations going as a part of these various derivative instruments. What we are primarily looking at is the the usage of them. If they are not put to proper use, they can result in disasters. We have seen over the last 20 years, improper use of the derivatives have really caused some of the best organizations in the world to shut down their operations. So the problem, it is better for us to understand the various case studies, the problems which derivative trading can bring up. For a simple example, if a trader has been provided an intention, provided an objective to hedge the instrument, hedge the risk using the derivatives, if he gets into a speculation position and things don't go in the direction of favorability, probably it causes multi-million dollar damages to the companies. So the consequences can be very much disastrous. Whatever is the role that is specified based on the organization objective, we have to make sure that the company and the traders are sticking to that particular role and not switching the roles. One of the best examples comes with one of the biggest traders with Barings Bank, Mr. Nick Leeson. He has been given the mandate to hedge and take arbitrage positions, whereas he has actually got into a speculation position, which has resulted in a huge disaster for the bank. You can go through the case study of the Barings Bank, or probably you can look at the movie called The Rogue Trader, which actually showcases this entire story in a very simple snapshot. This entire derivatives based disaster in a very easy to understand kind of a manner. So setting up of proper controls and make sure that the derivative trading is happening for the intended use itself. If someone has to get into a hedging position with the derivatives, they are doing the hedging itself and nothing else. And along with that, setting some kind of risk limits, the maximum exposure or the maximum amount that can be traded at any point in time, or the moment the loss crosses a particular limit, stopping the trading. And a regular monitoring of this trading activity needs to happen. Regular reporting, regular monitoring, to make sure that all these limits are getting adhered to. If used in a proper sense, they have the skill to reduce the risk drastically. They have the ability to generate profits to the organization, but the failure to use them in a proper manner or without proper analysis can cause ultimate disasters. Also, we'll see why derivatives can become violent disasters if not used properly in our later sessions. But just to talk about the basic introduction to the world of derivatives, this is what I thought I should present to you in the opening session, which talks about a very base introduction to the world of derivatives, the different derivative products, different kinds of derivative markets, and different kinds of traders that are involved with the derivatives market. If you have any further queries regarding the same, you can get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.